All right. So now we will talk about step one. Step one is identify the contract with the customer. Remember, there were 5 steps we talked about. Identify the contract with the customer, determine your performance obligation, determine the transaction price, allocate the transaction price to each of the performance obligation, and recognize revenue as the performance obligations are fulfilled. And of course, there is one other element of contract cost. So now we're going to talk in detail as to what all the meaning of identify the contract with the customer means from that perspective, right? So when we think about identify the contract with the customer, it's at a high level, it's a fairly simple thing. And when I say that, what does it mean? In a way, when you think about, let's say, what you do on a daily basis, you want to buy something, right? Or you want to sell something. So in a contract between two parties, either you are buying or you are selling, right? And of course, there could be contract from one to many, that one person is selling to many people, from that perspective. So now when you think about, when we say that, is there a contract, all right? And then when there are two parties to the contract, for a contract to exist, we need two parties to the contract, right? And when we say, is there a contract which exists or not? So what is it I need to think about? Is this arrangement is enforceable under a court of law, right? So a contract is defined as an agreement between two or more parties that creates enforceable rights and obligation. And when we say enforceable, it means enforceable in a court of law, right? Under the law of that particular jurisdiction, right? So if you are doing a contract in India, is it enforceable under Indian courts? If you're doing a contract with a party in, let's say, outside of India, both parties are outside India, are in the jurisdiction in which they're operating, is it enforceable or not? From that perspective, this can be written, oral. I'm just going to pause here. A contract is defined as an agreement between two or more parties in a way that creates enforceable rights and obligation. And I was trying to explain that what's the meaning of enforceable rights and obligation means that it is something which has to be enforceable in a court of law in the country in which this contract has been written, right? So if you're two parties in India who enter into this contractual arrangement, now these has to be enforceable in a court of law in India. Now if you are operating overseas, then this has to be operational, this has to be enforceable in a court of law overseas. This can be in any form, so the standard doesn't mandate that it has to be in a particular form. It can be written, oral, or implied by an entity, customary business practice. So if you make a promise, that also, in a way, depending upon what's your customary business practice, it does not exist if both parties can cancel without penalty. In a way, what we're trying to say is that there is no contract if, in a way, both any of the parties actually, or both parties can actually exit out of the contract without any repercussions, right? That means there's no consideration to be exchanged, there's no penalty to be done. I enter into contract, but I can in a way exit out of that contract at any time. Then it's only a contract in relation to the thing which has already been executed, right? So from a future perspective, and when you think about a contract, we're actually here talking about a contract which is to be yet to be executed, right? Which is yet to be executed. So what are some of the important things that parties have approved the contract and are committed to perform? Each party rights are identifiable. Each party payment terms are identifiable. Contract has commercial substance. It is probable that entity will collect the consideration it is entitled to in exchange for the transfer of goods or services to the customer. So essentially, again, when you think about a contract between two parties, right, what is it we expecting to know, right? That who's the counterparty, what's the name of the counterparty, right? What's the identity of the counterparty, right? Then what are my rights and obligation under the arrangement, and what are the rights and obligation of the counterparty? So what are your rights and obligation under the arrangement? Now if you were to fulfill your rights and obligation under the arrangement, then what is the consideration you are entitled for, when are you going to get paid in terms of your consideration. The contract has to have commercial substance, right? All accounting standards in a way are written from a commercial consideration perspective or for profit organization. So why are you doing this transaction, right? You do this transaction has to have a meaningful cash flow impact from your financial statement perspective or from your own cash flow perspective. And if you're doing this transaction, it is probable that you'll be able to collect, right, the consideration which is out there under the contract. So we'll try and understand with the help of some simple examples. So let's look at this purchase order, right? The question is the purchase order a contract? Very common in a way instrument is of contract what we see in the Indian parlance. And what does that mean? That if a company, let's say there's a buyer and a seller, and if the buyer wants to engage into a contract with the seller, many times you see that the buyer will issue a purchase order to the seller. Now, that purchase order essentially is supposed to specify that what is it, what is the product which is under consideration, how much quantity, what is the price, what all other terms and condition, how this will be settled. All of these terms and conditions are supposed to be in a way written as part of the purchase order. So what, when you see it, what it suggests that the purchase order creates an enforceable rights and obligation. The PO specifies the goods required to be transferred. So what are the goods which are required to be transferred, and the rights with regard to the same are specified. The transaction price and the payment terms are also stated in the contract. The contract has a commercial substance. It's important, okay? It's important that contract has to have a commercial substance for you to account for that arrangement under Ind AS 115, from that perspective. Let's think about contract approval, right? The parties must approve the contract. So when you think about any contract and then there are two parties, that both party A and B have to agree and sign off on the terms and conditions. The parties must approve the contract. The approval, again, since the contract can be in any form, the approval can also be in any form. I think what is important is that your ability to demonstrate that this has been approved, right? When this had to go in a court of law is a subject matter of litigation. So how do you demonstrate that this has been approved? The approval may be in written form, oral form, or in accordance with the customary business practice. But you should have the ability for that approval to be substantive as to how will you be able to demonstrate. So now let's look at an example that an entity may include a requirement in a contract for the customer to purchase a minimum quantity, right, of goods each month, but entity have a history of not enforcing the requirement. In this example, the contract approval criteria is met, that both the parties have signed off. You may have decided not to enforce the contract. I think that's a separate issue, but the contract criteria has been met if the evidence supports the customer and the entity are both substantially committed. So both of us are committed, but we have decided that, say, we want to continue the trade. I mean, this is a good faith clause that you should have purchased so much quantity. But if you fail to purchase so much quantity, let's say there are no penal consequences which are attached to it. Even if there are penal consequences, I as a seller, or you as a buyer, you may not initiating those penal consequences. Some of those understanding may still be there, but still fulfills the criteria because both parties in a way have approved the terms and conditions. If I were to enforce it, possibly contractually, I am in the position to enforce it. Okay, I decide not to enforce it. That's my choice, right? That's the choice I kind of make. Let's look at the rights. In a way, an entity must be able to identify its rights as well as the rights of the all other parties. So what are my rights? What are the other so rights of other parties, in a way that it may become my obligation that I have to fulfill others' rights. An entity cannot assess the transfer of goods or services if it cannot identify each party rights regarding those goods or services. Similarly, an entity shall consider those practices and processes in determining whether and when an agreement with the customer creates enforceable rights and obligation. All right. So what's important for you to visualize, is there a contract exist? Is there a contract which exists in the context of Ind AS 115? The contract has to be approved. Okay, the contract has to be approved. It can be in many forms. approved by both parties to the contract, has to be enforceable under a court of law, and the contract should articulate that what is the subject matter of the contract, right? If this is the subject matter of the contract, then what are my rights and obligation associated with the subject matter of the contract? Then what is the form of the consideration, in a way, which is required to be discharged if each party to the contract fulfill their performance obligations, in a way, and how is the settlement going to happen? From that perspective, all of that is required to be articulated and specified from the perspective of a contract for you to believe that it exists, right? Let's talk about the payment terms. An entity must also be able to identify the payment term for the promised goods or services within the contract. You cannot determine how much it will receive. If, let's say, for example, you cannot determine how much you will receive in exchange from the promised goods or services if it cannot identify the contractual payment terms. So you don't want to land up in a situation that I've supplied you goods or services, right? But I don't know when I will get paid. If you don't know when you will get paid, that means was there an enforceable contract? So you got to be clear that as part of any contract, what is my contract consideration? How is this going to get paid? All of that is what I need to be clear for me to say that the contract exists, right? The contract exists. Remember, we're still at the first step, right? First step is identify the contract with the customer. Identify the contract with the customer means that what are the things which I need to know for me to establish that there is a customer contract which exists, right? So whether it has the approval of both parties, whether it's enforceable under a court of law, whether the payment terms are identified, whether the rights and obligations of the parties are articulated under the contract, all of that is what I need to know. Now let's talk through the commercial substance, right? Whether the contract has a commercial substance. A contract has a commercial substance if the risk, timing, or amount of the entity cash flow, risk, timing, or amount of the entity cash flow is expected to change as a result of the contract. Okay. So, which is what we say, whether the nature, timing, right? You enter into this contract. So this contract has to result into a risk or reward scenario, right? It has to result into timing of your cash flows, impact your timing of the cash flow, or the extent of the impact that should be there from your own cash flow perspective. Otherwise, why I'm doing this transaction, right? That's the question. Is what we need to ask. Why do we need this? To prevent entities from transferring goods or services back and forth to each other for little or no consideration, to artificially inflating revenue. Why do we need this? This is a protective clause in a way. So let's say I can very well agree to A will sell to B, and then B will buy it back from A. What does that mean? That there was actually no sale, there was no transfer of goods, right? A transferred goods to B. So if I don't have this commercial substance, what happens if A will sell to B, right? For say $100, and B sell it to E, let's say for $105, for example, right? After 6 months, if there is a contract which has a repurchase agreement, then essentially what we're trying to say that A transferred goods to B, in exchange that he received $100, and then B in a way transferred those goods back to A, and in consideration B received $105 for the same goods. So what's the commercial substance of this transaction? In this transaction, the commercial substance is mere financing, that in a way A got access to the cash of $100. In return, B earned $5 as interest income over a 6-month period. So there was never an intent to transfer the risk and reward with reference to the underlying goods or services, right? So in a way, this was not a commercial transaction. This was actually a lending and borrowing transaction, from that perspective. So the onus to substantiate commercial substance, again, is on the entities. So it's a slight change in a way from the existing guidance here. The entity should be able to demonstrate a substantial business purpose exists. Otherwise, if there is no business purpose, you're not supposed to account for these transactions, or account for based on the substance of the transaction. So that's an area of judgment is what we need to look at. We're going to talk a little more on the commercial substance with the help of an example. So let's look at this example. A parent company sells a building to its 100% subsidiary at no consideration. Appropriate approvals under the Companies Act with respect to related party transactions have been obtained. The stamp duty at the ready reckoner rate has been paid, and the building is transferred in the name of the subsidiary. The subsidiary will lease the building to third party customers and earn lease income. There is no repurchase agreement between the parent and the subsidiary. The parent will account for the sale at its market price with a corresponding debit to investment in the subsidiary. The subsidiary will account for the purchase at the market price with a corresponding credit to capital contribution of the parent. So all the accounting is also in a way specified here. So the question here is, do we have a commercial substance? Now think about the commercial substance, whether it results into a risk change in the nature and timing of your cash flow. So now if you think about, the parent is actually going to transfer the building to subsidiary, and they're going to pay the stamp duty. It is done at the ready reckoner rate. Of course, they've not received any consideration, but that's my subsidiary, so I'm going to in a way record that as a contribution in terms of by increasing the value of my investment into the subsidiary, and subsidiary is going to record that as a contribution of capital. So in a way, I have done capital contribution to my subsidiary in the way of non-monetary transfer of assets, right? If I have done a non-monetary transfer of asset, the question is there a commercial substance? The answer is to that is yes. Why? The parent cash flows are going to get impacted because of this transfer. The subsidiaries cash flows are also going to get impacted because of this transfer. The future cash flows, as a result of which there is a substance in this transaction, right? And hence is to be accounted for as such from an Ind AS 115 perspective. Now, whether it is to be recorded as revenue or not, that's a separate issue, right? Why? Because this may not be the primary business objective of this entity to transfer a building to its subsidiary, right? But remember the scope, the property, plant, and equipment related transactions are also part of the scope. We need to appropriately determine how do you present this from an Ind AS 115 perspective in your profit and loss account, but it is accounted for based on the principles of Ind AS 115. So if you look at the response, the transaction has commercial substance because the building is legally transferred to the subsidiary. The subsidiary will own such building and in future and earn income by leasing to third parties. There is no repurchase agreement between the parent and the subsidiary. The fact that the subsidiary does not pay any consideration is not relevant because it is an investment that the parent has made in its 100% subsidiary. So there are elements of judgment, right? When we talk about commercial substance, there are elements of judgment, and we need to be careful about that while you apply that judgment. The key is that when you look at that judgment to say, is there going to be an impact on your cash flows, right? Is there going to be impact on the timing of your cash flows, right? Is there an impact from a risk and reward perspective to the parties to the contract? The answer to that is yes. That in a way it demonstrates that this has a commercial substance from that perspective. Moving forward to talk about the collectibility, another very, very important element. So when you look at the present guidance, right, what it says that collectibility has to be reasonably insured, right? Collectibility. So in a way, when we talk about collectibility, what is it we're trying to focus here, right? When we think about collectibility, so you enter into contract between the two parties, right? Parties A and B, and then you said, I'm going to transfer you certain goods, right? In exchange, you are required to pay me monetary consideration, say 100 rupees, and now that's the whole question, that I have done my part of the bargain by transfer of goods. Now when this the other party, if you have sold goods on credit, right, this only question comes if you are selling goods on or providing rendering services on credit, right? If you've done on cash, right, there is an immediate exchange of consideration. I give you 100 rupees worth goods and you transfer cash at the same moment, then there is no issue. But this issue is there if you are selling goods or rendering services on credit, right? So now I have done my part of bargain. You still have to pay me, right? You still have to pay me. So you got to establish that the counterparty is has the ability and the intent to pay the amount of promised customer, right, consideration, right? So the collectibility refers to the customer intent and ability to pay the amount of promised consideration at the time when you entered into the contract, right? Or actually at the time time when you're discharging, when you're fulfilling your performance obligation. Because if at that time you were to believe that this customer does not have the intent or ability to pay at the time you're doing your fulfillment of performance obligation, what does that mean? Then you may not be able to recognize revenue at the first place, right? Because you will then only recognize revenue when you actually receive money, right? Like many times, the cash and carry, so to say. A lot of time we hear, right, the cash and carry business. In a way, what does this mean? This means that you have to first pay me cash before carry the goods, and we've seen this in some of the airlines example, when the oil marketing companies have put them on cash and carry model, that you got to first pay cash, then only you will take the material or take the oil from that perspective. So in a way, I no longer have the faith in that company that you have the ability to pay, right? Even though you have an intent to pay, but you don't have the ability to pay, and hence I'm going to put you on cash and carry. So if you don't have the faith that you will have the ability to pay, then essentially you will not be able to record revenue. You will only be able to record revenue when actually you're going to collect the money from that perspective. And hence, again, it's an area of judgment. It's an area of judgment. An entity must determine that it is probable that it will collect substantially all of the consideration to which it will be entitled for under the contract in exchange for goods or services that it will transfer to the customer. This criteria is also referred to as the collectibility assessment. So now the term probable has been defined in Ind AS 37 in a way to say that probable means more likely than not, right? So more than 50% threshold that you are likely to collect. So the term reasonably insured, or reasonably assured, that has been replaced with the term probable, that it is more likely than not that you will be able to collect the consideration of what you are entitled for, either for the sale of goods or for renting of the services. The important judgment here is that the customer has the ability and intent to pay. Assessment relate to the transaction price, may be less than the stated contract price if the entity intend to offer. So you may want to offer a price concession or a discount. So let's say I've sold goods worth rupees 100, but I know that I'm going to extend a discount of 20%. That means you only intend to collect 80, right? If you intend to collect 80, then you got to make this collectibility assessment also with reference to 80, and 80 is your revenue, because 20 is then discount, right? So whatever is going to be your revenue, that is what you have to assess the intent and the ability of the counterparty to pay, and it has to be probable at the time of you recording the transaction. And in making this assessment, the credit risk was an important thing to determine if the contract is valid. However, customer credit risk should not affect the measurement or presentation of revenue, right? Customer credit risk will not impact the measurement or presentation of revenue from that perspective. Let's look at some examples in a way. So there is a customer, New Way Limited, decides to enter a new market that is currently experiencing economic difficulty and expects that in future economy will improve. New Way enters into an arrangement with a customer in the new region for networking products for promised consideration of INR 12,50,000. At contract inception, New expects that it may not be able to collect the full amount from the customer, right? How New will recognize these transactions? You expect at the beginning of the contract itself, you believe that New will not be able to collect the full amount because you venturing into a new market in a way which is recovering, going through a difficult time, right? And possibly then what we're trying to suggest here is that you will end up offering discounts, either a direct discount or an implied discount, right? So discount can be in a way, so to say, price concessions, right? And when we say price concessions, it can be direct or it can be implied, right? So you need to make this assessment at beginning itself, that whether if I'm going to sell sell goods 12 lakh 50,000, do I intend or have the ability to, or the counterparty has the intent and ability to pay entire thing, or they're going to only pay me, let's say, 10 lakh rupees? If they're only going to pay me 10 lakh rupees, then that is what is your revenue, right? That is what is your revenue in that scheme of thing. So I got to again make an assessment here, assuming the other criteria that what is the contract is enforceable, the rights and obligation to each of the counterparties, what goods or services I need to provide in a way, and then you fulfill your performance obligation, and we are looking at the collectibility to say that contract meets the other criteria within the scope of model Ind AS 115. You need to assess collectibility is probable, right? And in making this assessment, I'll assess that whether the customer has the ability and intent to pay the estimated transaction price, which may be an amount less than the contract price. And if this is an amount less than the contract price, say INR 10 lakh, right? If it is INR 10 lakh instead of INR 12 lakh 50,000, then that is going to be my revenue in this example. All right, INR 10 lakh. That is going to be my revenue from that perspective. Okay, let's move forward to talk about contract terms. So we talked about collectibility, we talked about rights and obligation, we took an example of identifying a contract like a purchase order. Let's now talk about contract term. How do you identify a contract term, and why is this important? This is important for you to visualize and determine what's the total duration of this contract, and what's the standard suggest that entity applies Ind AS 115 to the contractual period over which the parties to the contracts have enforceable rights and obligation, right? Now, for any contract term, for you to assess, you need to focus on termination clause. Straight away, go to the termination clause, right? When you're looking at any contract and you're trying to assess what is the contract term, go to the termination clause, right? That how you can actually end up terminating this contract. What are the scenarios in which you can terminate this contract? If yes, many times you will see, in fact, majority of the time you will see that the contract can be terminated by any party at convenience. Okay, based on your own convenience, you can terminate without a penalty. If you can terminate a contract without a penalty, and if there is only a minimum notice period what you need to give, then that notice period actually becomes the term of the contract. But if you cannot terminate a contract in a specified period, and if you were to terminate a contract within that specified period, and if that results into a significant penalty, that means it acts as a disincentive in your ability or your willingness to terminate the contract. Then you look at the longer time as the contract term, and some of that possibly you can also relate to the guidance in lease accounting, right? Which is to say that if there's a contract between lessor and lessee, and if there is a 12-month contract, you cannot terminate, or you can terminate by giving a 3-month notice, then 3 month actually becomes a contract term. If you have a 5-year contract and you cannot terminate, if you terminate in between, then you have to compensate me for the unpaid rentals, etc., then it becomes a 5-year contract from that perspective. So you need to evaluate the contract term with reference to the termination clause, and is there any penalties or cost associated with termination for you to assess what is the contract term. So each entity should consider the termination clauses when assessing the contract term. If the contract can be terminated at any time for no compensation, the parties do not have enforceable rights and obligation, right? In contrast, if it can be terminated but requires payment, then in a way it becomes a longer period, right? Management should apply, this is another area where you need to apply judgment in determining whether a contract clause or whether a termination penalty is substantive or not. Recently I was looking at a situation where the total size of the contract was 500 crores, and the termination penalty was only 2 crores. Now the question is, on a 500 crore, if you only have a termination penalty of 2 crores, whether the termination penalty is substantive or not, and it's an area of judgment. In my view, in that particular contract, we took a view that this is not substantive, right? The termination clause, the termination penalty is not substantive. There's only 2%, not even a percentage of the contract value, right? But depending upon type of the contract, type of the arrangement, you may get to a different answer. For example, if you were to say that on a 500 contract, my cost of fulfillment of that contract was 499 crores, and I was only making a crore, and there is a 2 crore penalty which I have put in. If the counterparty were to terminate, then that may be a substantive amount, from that perspective. So you got to evaluate some of this with reference to the substance of the arrangement, from that perspective. So let's take this example on contract term. A gymnasium entered into a contract with a new member to provide access to its gym for a 12-month period at INR 4,500 per month. The member can cancel his or her membership without penalty after 3 months. What is the contract term? It's very simple. Since you have to give a 3-month notice, that 3 month in a way becomes your contract term, right? That 3 month is your contract term from that perspective. So there's a 3-month notice period, so 3 months is your contract term in this example, right? So let's move forward. Now we're going to talk about another concept of combining contracts. Okay, we're going to talk about another concept of combining contracts. Now, when do we combine contracts, and why is this concept important? Let's just talk about it. So what happens in many scenarios, we see that you're trying to enter into a contract with a counterparty, and then you're trying to sell many things together, right? I can do this also for you, I can do this also for you, and then if you to buy only this, the price is 100. If you to buy both of them together, the price is 160. However, if you buy them individually, the price of this is 100, the price of this is also 80, for example. So there's 180 as one price, whereas if you buy them, together, I can only charge you 160, for example, right? So, or they're so interlinked in a way that one cannot exist without the another. From that perspective. So let's say if I'm doing a building construction project, right? I'm saying that I'm going to do a drawing room for you, I'm doing a kitchen for you, I'm going to do a dining room for you, I'm going to do a bedrooms for you, so on and so forth. But the whole question is, if I'm given a house to construct, if you will not do a bedroom or a dining room or a kitchen, then what is it actually you do? Can you really do a modular pricing, or actually the contract is for construction of a house, right? And then how do you look at this? Even if I have said that I'm going to pay you 100 rupees for kitchen, 200 rupees for bedroom, and 300 rupees for my drawing room, in total it is a 600 rupees contract. The question is, are you going to look at each of these components individually, or are you going to look at them together from the perspective of revenue recognition? And that's the whole concept of combining contract versus separating contracts, right? So when you think about the combining contracts, the question is, are the contracts entered into at or near the same time with the same customer or related parties of the customer, right? If the answer to that is yes, are one or more following criteria are met, contracts are negotiated as a single commercial package, consideration in one contract depend on the other contract, goods or services promised a single performance obligation. If yes, it is a single contract. If you get to a no answer, then you got to account for it as a separate contract. Account for it as a separate contract. Let's look at this with the help of an example. So there is a manufacturer of airplanes for the Air Force, negotiates a contract to design and manufacture new fighter planes for a Kashmir Air Base, right? At the same meeting, the manufacturer enters into a separate contract to supply parts for existing planes at other bases, right? The question, so I'm trying to enter a new contract to supply of new airplanes. At the same time, since I was your existing vendor, I said, now I'm here, that you want to also sign off on the spare parts for existing airplanes. The question is the supply of spare parts in relation to existing airplanes versus supply of new airplanes. Do I need to combine them, or do I need to treat them two individual contracts? So in a way, you got to, when you're making this judgment, are they too independent to each other, or are they too dependent on each other for you to evaluate whether I need to combine them or I need to treat them as two separate contracts from that perspective, right? So when you look at in this example, I mean, one is for existing plane, the other one is a new plane. I mean, these are, in a way, are not linked to each other, though may be negotiated at the same time. So they can possibly be treated as a separate contract, right? Contracts are negotiated at the same time, but they appear to have separate commercial objectives, and hence they are not dependent, and you can possibly treat them as separate contracts. Remember, this is an area of judgment. This is an area of judgment. Even though if you were to treat them as a separate contract, we still possibly need to figure out, how do I allocate the contract consideration to each of these contracts? Is there a discount, which, or is there a cross subsidy happening? I think that's where the key judgment is. Because I've agreed to sign up the spare part, I'm going to give you a discount on the airplanes, or because I agreed to sign up the new airplane order, I'm going to give you discount on existing spare parts. You got to establish some of this, for you to apply and do the accounting appropriately, from that perspective. Let's talk about contract modification. So we've now talked about what is a contract, right? Contract between two parties, which has to be enforceable under a court of law, and then it has to be complete in its entirety. And when I say complete, means what? It has to identify the rights and obligation of each of the parties to the contract. It has to also establish the contract consideration, and then it also has to establish that how the contract consideration will be settled, from that perspective. And also it has to have commercial substance. And then if there's a contract, there has to be evaluation of a term. If I'm evaluating a term, how do I evaluate it? With reference to termination clause, to say, is there a penalty or is there no penalty? And then I need to look at, do I need to combine the contracts? If there are multiple contracts getting signed at about the same time, do I need to combine them and look at them together, or I need to look at them and treat them as individual contracts from a revenue recognition perspective? And I need to evaluate commercial substance for each of the elements, and commercial substance is established depending upon the risk. Is the risk and rewards are changing? Is the nature and timing of my contractual cash flows are changing as a result of that arrangement? From that perspective, let's talk about contract modification, right? What is a contract modification? So you already enter into a contract. Now both parties are coming together and they're changing, either what are my rights and obligation, or either they are changing the contract consideration, or they're adding, some scope to the existing arrangement. They're deleting the scope from the existing arrangement, and they may change how this needs to be fulfilled, etc. So if there's a change in the scope, price, or both of the contract, and it is approved by both the parties, and the change is enforceable. So when you say, is there a modification, you got to assess what was the scope. Is there a change in scope? Is there a change in price? Is it approved by both the parties, and is it enforceable? If the answer to that is yes, that means there is a contract modification. Now, how do you account for contract modification, right? Now, the accounting for contract modification depends upon that in your assessment, whether the contract modification actually qualifies as a separate contract, or as a continuation of existing contract, right? So is it considered a part of the original contract, or it is considered as a separate contract? If it is a separate contract, then you again follow the steps of revenue recognition under Ind AS 115. But if it is a part of the original contract, then you do essentially a cumulative catch-up accounting, right? You will end up doing a cumulative catch-up accounting, and we will try and understand this with the help of an example where we will say that it is considered as a separate contract, and how the accounting changes when it is considered as a part of the same contract. Then what is the impact on the accounting, from that perspective. So if you were to look at a flow chart, how do you evaluate this? Is the contract modification approved? Okay, the answer to that is yes. Does the scope of the contract increase due to addition of promised goods or services that are distinct? If the answer to that is yes. Does the scope changes, the price changes, it is a separate contract. Now, no, the no modification exists if it is not approved anyway. If there is no change in scope, right? Then you are got to ask the question: are the remaining goods or services distinct from goods or services transferred on or before the date of the contract modification? If the answer to that is no, again, it forms part of the existing contract and a single performance obligation. You got to deal with this as an adjustment to the existing contract price. And again, we will try and help to understand this with the help of an example. It may also result into a termination of an existing contract and creation of a new contract. From that perspective, if you modify the scope and term, from a perspective, and we will try and again help to understand, how do we need to deal with in different scenarios. Okay. So let's take this example, a modification that is going to constitute a separate contract. So example suggests that an entity promises to sell 120 products to a customer for INR 1,20,000, INR 1,000 per product. The products are transferred to the customer over a 6-month period. The entity transfers control of each product at a point in time, right? At a point in time over a 6-month period. After the entity has transferred control of 60 products, so total was 120, I have now transferred 60. The contract is modified, right? After 60, the contract is modified to require the delivery of an additional 30. I'm placing more order for 30. A total of 150 identical products to the customer at a price of now INR 950 per product for the additional 30, which is the standalone selling price of such additional product at the time of placing this additional order. The additional 30 products were not included in the initial contract. The question here is this additional order is a separate contract, or it's a part of the same original contract, right? And that's where you got to do an evaluation. Is there a change in scope? Yes, there's a change in scope. There's now more units to be transferred. Is there a change in price? Yes, there's a change in price. Is the change in price represent the standalone price for the change in scope? The answer to that is also yes. If that's been the case, then it is a separate contract. If the answer to that would have been no, then it would have been the part of the same contract, right? When the contract is modified, the price of the contract modification for the 30 additional unit is INR 28,500. The pricing reflects the standalone selling price of the product at the time of contract modification, and the additional products are also distinct from the original product. All these products are individually identifiable, and hence the modification for the additional 30 product is in effect a new and separate contract. So you will go about, let's say, what does this mean? If you continue to supply your existing 60 unit, you will record revenue for them at 1,000. Once you start supplying this 30, you will record revenue for them at 9,950 per unit. Right here, you will record 1,000 per unit. For the same product, you will record revenue at a different price point, because this is how you agreed with the customer, and these are two separate contracts. And as you keep on fulfilling your performance obligation, you will record revenue as your obligations are fulfilled. Now we will look at an example where we may have to look at them as a continuation, right? Modifications that results into continuation of existing contract. So there's a company, Growth Limited, enters into an arrangement with a customer for infrastructure outsourcing deal. Now, based on its experience, the growth limited determines that customizing the infrastructure will take approximately 200 hours in total to complete the project and charges INR 150 per hour, right? Now, after incurring 100 hours, Growth Limited and the customer agree to change an element of the project and increases the estimate of labor hours by 50 hours. And they also agreed a rate card of 100 per hour. So I changed my rate from 150 to 100 rupees an hour, and I also increased the scope. Agrees that I've agreed that I'm going to spend another 100 hours of time, right? So the question here is this a new contract or is a part of the original contract itself, right? And that's an element of judgment to say, look, I was under an obligation to deliver something. When I was trying to do this, both parties come together. No, I will modify what you agreed to do, and for we to agree this is my additional effort, and now I'm going to compensate you for your additional effort at this rate, from that perspective. So now it seems here that it's actually amendment to an existing contract, right? Considering that the remaining goods or services are not distinct, the modification will be accounted for on a cumulative catch-up basis. How will you do this? And that's important for you to understand. So my original contract, 200 into 150 is 30,000. My new contract, 50 into 100 is 5,000. My total contract consideration is 35,000. Now I have already delivered revenue 100 unit at the rate of 140. That's my average is 14,000. How much I have recorded revenue, because originally I was contracted 150, so I was recording revenue at 150. So I've recorded revenue of 15,000, and that's where it results into a reversal of revenue by 1,000 rupees. And that's why it is important for you. So had this been a separate contract, then I wouldn't have reversed this 15,000, this 1,000. I would have continued 15,000, and then I would have determined that what portion of services are now being fulfilled. For the new, I would have charged at 100. For the existing, I would have charged and continued to record revenue at 150. But because I've concluded that this is not a modification which results into a separate contract, this modification actually results into a continuation of the existing customer contract itself, and hence I now need to do what we call as cumulative catch-up accounting. Okay, now if I to do a cumulative catch-up accounting, this is what it is resulting into an impact to say that now I've done work for 100 hours. I'm now getting an effective bill rate of 140, and hence I'm entitled to record revenue of only 14,000. So 1,000 is actually come as an immediate reduction in my revenue in the current period. Okay, so let's look at another example, a modification which results into a termination of existing contract and the creation of a new contract, right? So in this example, there's a contract with Mr. K to provide a machine for 2.5 million and 1 year of maintenance services for 55,000 rupees per month. Now on October 1, I've agreed to modify the contract to reduce the consideration of services from 55,000 to 45,000 rupees per month. Now, if you look at this, the services were provided on an ongoing basis. So as a result of which I was recording revenue on a straight line basis on a maintenance arrangement. After 6 months, I've decided to modify. This in a way results into termination of an existing contract and entering into a new contract to record revenue at the rate of 45,000 rupees per month on an ongoing basis, right? The next 6 months of services are distinct from the services provided in the first 6 months before modification. In a maintenance contract, every month, in a way, every day, one can articulate is a distinct performance obligation, in a way, as that's what I'm trying to do. But there are similar, in a way, they gets aggregated from a revenue recognition perspective. So how you look at it, that if your 6 months have elapsed and whatever you've recorded, that's done and dusted. So new contract you want to record on a go forward basis. You will not do a cumulative catch up here. Cumulative catch up you only do when you're not able to demonstrate that these are distinct goods and services which you have entered into an arrangement, which was my previous example of construction services, where you agreed to a scope change, and you also agreed to offer a discount for the new efforts from that perspective. And that's where the scope and pricing were not representative of entering into a standalone selling services arrangement, and hence it was considered as a continuation of the existing arrangement from that perspective. So now, if I were to summarize in a way what we've talked about, we talked about criteria for recognizing a contract. It has to be approved by both the parties to the contract, has to articulate the rights and obligation of each of the parties. It got to identify the payment terms. It has to have a commercial substance, and also the collectibility has to be reasonably assured, and that is defined as probable as to what you as a party to the contract you expect to collect, intent and ability to pay. All of these are very, very important assessment what you need to do to establish that the contract exists. Then you look at the contract term. The contract term, for you to assess, you got to look at the termination clause. And termination clause, it suggests that if there are no penalties, you can be terminated at convenience. Essentially, then it has no in a way contractual term. So termination penalty is a very, very important element. You got to look at then the combining contract. So when do we combine contracts? So when you're negotiating multiple contract at about the same point in time, the judgment here to be made that do I need to look at them individually or do I need to look at them together? Now the question here is that, how is this being perceived from a customer perspective? Are they all interlinked, intertwined? So one has no in a way meaning without the other. Then you will look at them together. Otherwise, you can look at them individually. So near same time with the same customer with a single commercial package, consideration depends on other. There's a single performance obligation. These are all criteria in a way for you to determine to combine a customer contract. And then we talked about a contract modification. Whenever there is a change in the existing terms and conditions for an outstanding contract. So is there a change in scope? Is there a change in price? Now, whatever you have agreed to change the scope and the price, are you charging a separate standalone price to the customer? Are they part of the same performance obligation, or the new performance obligation which you have agreed can be separately identified? Is it a distinct performance obligation for which you're getting compensated on a fair price basis? If the answer to all of that is yes, then it is a separate performance contract, separate contract. If the answer to that is no, it is not a distinct performance obligation. You're not charging a standalone price for that performance obligation. It is actually to be merged with the existing contract, and then you will say that it is a continuation of the existing contract. Otherwise, it is a separate performance obligation or a separate customer contract to be evaluated and accounted for appropriately. Now we will move to step 2. So we've now talked about step 1, which is identify the customer contract, right? Interesting. Identify the customer contract, determine all your performance obligation, determine the transaction price, and then allocate the transaction price to each of the performance obligation, and then record the revenue as and when the performance obligations are fulfilled. So now we've talked about the overarching principles around revenue recognition, and we've also talked about identify the contract term, identify the contract with the customer, which is step number 1. Now we're going to talk about step number 2, which is to identify the performance obligation in the contract. All right, I'm going to take a pause here.